Good morning. I'm Gord Long with the Financial Repression Authority. I have Leo Kolivakis, publisher of the well-followed website Pension Pulse, joining us here this morning. Welcome back, Leo.
Thank you. Nice to be back, Gordon.
I've been looking forward to talking to you again. How quickly time goes. And I'm going to, I wanted to jump right in because we're always short of time. But before I do, Leo, we have so many new listeners that may not know yourself and your background and Pension Pulse. Could you just tell them your involvements and what Pension Pulse is?
Sure. Very briefly, Pension Pulse was started in June 2008, right after the financial crisis. And it was a blog that was started to cover pensions and investments. And basically, my background is I worked at two of the largest public pension funds in Canada. I've also worked on an economist at major Canadian banks and Crown corporations. And I started this blog because I thought there was an important topic to cover and it wasn't adequately addressed. You know, pensions aren't exactly the sexiest topic. But now that people are getting older and they're worrying and they're starting to think about public policy and politicians are starting to think about pensions, I think it's a very important topic, as well as covering what's going on the investment side. Because pensions are all about assets and liabilities.
I need to stress with our listeners, and I follow Leo's work, it's great economic analysis and it's great insightfulness into investments and where to be looking for real opportunity. It's not covering boring subjects that you might associate with pensions, though that is an important subject and you obviously touch on it. So it's definitely worth visiting the site. Leo, let me just jump right in with a question to you. And I have up here a chart that shows your concerns, structural issues that are going on in the world that we need to pay attention because you clearly believe we're in for a period of deflation.
Right. I think we're we're entering a period of long deflation. And I discussed 6 structural factors. And I will go over them. One is the global jobs crisis. So there is a crisis going on around the world, especially among young workers, and that in itself is compounded by the fact that more and more people are retiring, the baby boomer generation. So you have a demographic issue, the aging of the population. You have a global jobs crisis. You have rising inequality, which I talk about a lot, meaning wealth is being concentrated increasingly in the hands of fewer and fewer people. And that concentration of wealth doesn't stimulate aggregate demand because when wealth is concentrated in fewer and fewer hands, as Warren Buffett said, the marginal utility of an extra $1 billion to a billionaire isn't as strong as it can be for millions of others who need that money to basically make do with their lives. So you have the financialization of the economy. Right now, Gordon, I'm reading a great book by John Kay. It's called Other People's Money. I highly recommend you read it. British economist who writes in the Financial Times columns. It's just a great book on the financialization of our economy. And I talk about this on my blog, how wealth is being concentrated. You have this new emerging class of hedge fund and private equity billionaires that are basically managing a lot of money of public pension funds too. And these people are, they're running great funds, but they're also becoming extremely wealthy in the process. And a lot of the reasons why is because they're charging hefty fees to these public pension funds to manage, these private equity and hedge fund assets. Now, so just to get back to on deflation, inequality or rising inequality is a problem. How are we going to address that problem? Then you get into political discussions. But this is a big, big problem for stimulating aggregate demand. And even Greece's now defunct ex-former finance minister, Yanis Varoufakis, talked about the global glut of savings relative to the global, glut of jobs. I mean, there's a mismatch there, and we're not putting that money to good use. I.e., either corporations are hoarding the cash, or rich billionaires are hoarding the money, and that money is not being put to good use to create jobs, to stimulate aggregate demand. So there's a mismatch there. There's a problem. So rising inequality is one. High structural debt, i.e. governments are increasingly constrained by how much they can spend and where they can spend. And this too is highly deflationary because it's not stimulating aggregate demand.
Quantitative easing was brought out was to twofold: bring demand forward and give us a kickstart after 2007, 2008 crisis. But it was supposed to also create the wealth effect, which would stimulate even more demand. Well, it created the wealth effect, but it created inequality, like, in my opinion, like we've never seen before. And I absolutely agree with that. And it's gutted, in my observations in America, it has gutted our middle class, who are barely able to get by. And if you look at the pensioners, the money they're trying to live on today, it's shrinking demand. I mean, they're just they're having to pull in, never mind saving any money. And any kind of dollars they have, they're saving to pay debt or to just get by on.
Absolutely. I mean, and if you look at the political debate, you look at the why is someone like Bernie Sanders resonating with so many voters?
Precisely.
Because some of the issues he's talking about are bang on. When he says we bailed out Wall Street, now it's time for Wall Street to bail out Main Street, he's absolutely right. Right? I mean, the guys on Wall Street might not like hearing that, but the reality is they bailed out Wall Street with government money and central banks printing money, which basically allowed Wall Street to use that money to speculate more and more on assets, enriching them a lot more, creating a huge problem in terms of rising inequality in the United States. And I think now that's starting to resonate with voters. Voters are really, really tired of hearing about bailing out banks and we got to take care of the banks. People are saying, well, what about taking care of Main Street? That's where the economy.
We're in the middle of, as you well know, or might know, primaries and caucuses down here, and the two leaders on both sides, Bernie Sanders and Donald Trump right now, are anti-establishment, and their views are different, but they're filling. Both of them are filling the auditoriums. More the millennials, younger crowd for Bernie Sanders, and a different Republican crowd for probably what's remaining of the middle class for Trump. But they are resonating. And as I heard Trump say the other day, do you think if we really had 5% unemployment, we'd have this kind of auditorium filled? Nobody'd be here if we had 5%. He says
no, because people would be happy. Numbers. Right,
exactly.
There are a lot of angry voters out there. So that anger, that's where that Sanders, that's where Trump is doing well, because he's harnessing and he's able to channel that anger, and his messages resonate to that constituency, whereas Bernie Sanders is able to resonate his message with younger voters who are quite honestly saddled with debts. I mean, they're coming out of university and they're going to be saddled with huge debts for decades to come, and they're saying, who's taking care of us? I mean, and that's the problem here. So you have very angry voters. The establishment is not talking to them, or not, it's not resonating anyways to them, and people are tired of the same old message.
And I don't think it's unique to the United States, too. If I go to Britain, I see Corbyn becoming much stronger out of nowhere in the Labour Party. I see Le Pen in France. I see Brillo in Italy. I won't put Trudeau in that category in Canada, but we're seeing mavericks, anti-establishment becoming essential in many, many, many countries because of this frustration and the youth themselves feeling they don't have the same opportunity. Are you observing that?
I can tell you that even in Canada, Justin Trudeau's Liberals swept into power because people were tired of the establishment message. They wanted a young, fresh face. And a lot of the votes he harnessed were precisely people that were angry at our former Prime Minister, Stephen Harper. So there was a huge wave of anger votes that said, enough's enough, we need a change.
So what does this mean for investors, Leo, with this heavy deflation going forward? I have up a chart here, some of the asset allocations that you think that's going to lead to and we should be giving thought towards.
Okay, so let me, again, the 6 structural factors very quickly. The global jobs crisis, aging demographics, You have rising inequality. You have increasing amount of debt. And you have technological change where everybody's going to Amazon and all these sites to find cheaper and cheaper goods. Now, some people will argue with me that the lowering of oil prices is very stimulative, and that will eventually pass through the consumer, and that's very inflationary. And this is where I disagree with some people. I think the lower oil prices aren't just due to fracking and the supply side revolution. I think there's a demand side to that. There's a slowdown in economies, and people focus too much on oversupply and not enough on deficient demand, global demand for oil. Now, what is deflation? Getting back to your question, what does deflation mean for people's investments, for pension funds? Well, deflation basically means we're going to have ultra low rates for a very, very long time, possibly negative interest rates. And that means in order to make your, if you're a pension fund, in order to make your actual return targets, you're going to need to take increasing amount of risk, either in private markets, in hedge funds, in real estate, in infrastructure, or in stocks and corporate bonds in order to attain your bogey. And what it means also is you got to prepare for an era of lower returns. Lower returns means most people are going to have to work a lot longer to be able to retire comfortably. And pension funds are also going to have to assess longevity risk with people who are living longer and say to themselves, do we have enough assets to cover our future liabilities? Now, as you know by reading my blog, I'm a very, very ardent defender of the defined benefit plans. And I believe that defined benefit plans are the way to go to handle the retirement needs of our citizens. But in order for that to happen, you first have to get the governance right, which I think we have gotten it right in Canada, where public pension funds operate at arm's length from the government, and they are able to bring assets internally and lower costs, and they are able to deliver the returns that they need to deliver in order to cover the long-dated liabilities. And they do that by hiring really, really smart pension fund managers, and they are absolutely excelling in terms of the global, in terms of global pension funds. Canadian public pension funds are among the best of the best.
I believe, I don't know if you agree with me, Leo, I believe we have a pension crisis in America, and I'm specifically referring to a number of elements. One, the unfunded levels that we see at the state and local and even the federal level, and a lot of for the remaining corporations that do have defined benefits, it's massive. And I'm guessing or seeing numbers anywhere from $5 to $8 trillion. That's the ones that do have defined. The vast majority of Americans now are on a contributory pension plan, and their average 401k is $18,000.
Right.
I don't know how you retire on that, and maybe your Social Security is going to be $1,600 a month. So
401ks, which have become the de facto pension plans for most Americans, are an abysmal failure. It's time for us to just state that. You cannot retire on 401ks. There is absolutely, it's going to be, you're condemning a huge subsection of your population to pension poverty if they're going to rely on their 401ks to retire on that money. So this is why I am totally against 401ks as a retirement policy. And you're right, the U.S. has a huge problem in terms of public pension funds. Some states are doing a lot better than others. Some states are really in a mess. I mean, I look at states like Illinois, Kentucky, there's a few of them that are just, they're not even covering 60% of their liabilities, future liabilities. So when you decline below the 80% threshold of the amount of assets you need to cover future liabilities, you start getting into a lot of problems. Now, a lot of the problems in the U.S. are also, quite frankly, because there's too much government interference. Public pension funds are not run properly. They're not run at arm's length from the government. So what that means is you get a lot of civil servant types being hired at public pension funds, and you're not getting the best to be managing those funds in the best interests of your contributors and all your stakeholders, which is what we do in Canada. So in order, though, to hire the best, you need to be able to pay them properly. In order to pay them properly, you need to set that governance where the state government just doesn't meddle in public pension funds. You have an independent investment board overlooking your pension fund managers. You hire qualified people and you pay them properly. Maybe not Wall Street salaries, but good enough to attract them to pension funds so they can manage public and private assets internally, which is what we're doing in Canada. It's not a rocket science. It's just mind-boggling that they're not doing this in the U.S. Now, corporate, I believe eventually what's going to happen in the U.S., you're going to have to enhance Social Security and shift Social Security so it looks more like the Canada Pension Plan Investment Board. We have a huge national pension fund called CPPIB up here, which manages the assets of all Canadians. I think the same thing's going to happen in the U.S. And at one point, that's going to be the solution to this pension crisis. In order to do that, though, again, you have to get the governance right. Now, I don't know if you're familiar with CPPIB, the Canada Pension Plan Investment Board, but it is the investment board that handles the investments that Canadians contribute to their Canada pension plan. I don't know if you are aware of our national pension fund, but it's doing extremely well. It's run well. It's not perfect. I'm not saying that Canadian public pension funds are perfect. Far from it. I'm very critical of them sometimes, but they are much better than anything in the U.S., in my opinion. And the reason they're better is because they got the governance right.
Well, I would suggest in the United States the governance is such with external people managing these funds are taking out the fees that are in lieu of you hiring these high-priced help to manage your own fund, and there's a big problem. I would also argue, Leo, that our problem is not necessarily just at the federal and state level, which we see as large, but is at the local level. That is the towns themselves who didn't put the money aside for pensions. And now I know in my little town we have 3 chief of police, 2 fire chiefs, but only one each shows up at work because the other ones are on retirement. We have 55 constables, but we really only have 14 to show up. But they didn't put any money aside. So Gordon, suddenly the budgets are going right through the roof.
I completely agree with you. That's a disaster in the making. Local municipal pension funds. I would have done away with all those pensions a long time ago. Rolled them up into at the state level or at a federal level, and this way you have it run properly. It's more transparent. People know how much money is going in, how much money is going out, what the liabilities are. Now there's nobody really knows what's going on at the state and municipal level until it hits the fan, and then everybody finds out that what's going on here is that there's a disaster at the state and local level. And I would have done away with all those those municipal and local pension funds a long time ago. Rolled them up at the state level and really done away with that, because that's just a disaster waiting to happen. You should have amalgamated those pensions a long time ago. And the reason why you do that is also you want to save on administrative costs, and you want, it would be in the best interest of all stakeholders, including taxpayers. Now what's happening is whenever these these municipal or local pensions go up, well, your property taxes go up to pay for these pensions, right?
Precisely what has already begun in America. So what I'll refer to as the yuppie palaces that everybody moved in and thought they made money. Now the taxes are coming along to support them.
Right.
And houses, modest homes with $25,000 a year in taxes. I'm seeing that in New Jersey. I have friends in Chicago talking about these kinds of things, where you're retired, that's your Social Security check. So, and it's across the board because the local have no way to solve. They can't print the money. They don't have the taxation, print the money like the federal government, the taxation that the state has. They just have property tax. And that's their only way out. And that in itself cripples the middle class. It cripples everybody because housing's such a big part of their income. So there goes your demand.
Right.
I believe it's a huge crisis.
It's a huge crisis. And then you talked about also large corporations that are either doing away with defined benefit plans altogether, shifting them to defined contribution plans. Why? Because they can't afford these plans anymore. So that's another disaster in the making. Because don't forget, Gordon, I wrote this a comment a long time ago called the United States of Pension Poverty. As more people retire in poverty, well, that puts a lot more stress on healthcare costs, on social welfare costs. So for me, pensions are important because we've proven in Canada, if you have people retiring with safe, secure, defined benefit pensions, well, guess what? They know the income stream that's coming to them for the rest of their lives. They're able to plan their spending accordingly. And when people spend at an older age, well, the governments collect sales revenues and the whole economy is better off. You're also paying off long-term debt. So for me, it's very simple. Good pension policy is good economic policy over the long run. The problem is getting politicians together so they can see my view of things, the big picture, I call it. And it's actually it's very simple for me because I write about this stuff all the time. And I see all these trends that are going on. The global shift out of defined benefit into defined contribution plans. And defined contribution plans, they're getting a lot better. They're getting a little bit cheaper, but they will never match large, well-governed defined benefit plans. And they are way too beholden to the vagaries of public markets. And that's what the ultimate problem is. When people retire, let's say, I don't know, in a year like 2016, when markets are getting killed, it makes people, it's not inherently unfair. Whereas someone who retires in a bull market will enjoy, a relatively safe, nice, comfortable retirement. So defined contribution plans are inherently unfair. They are not, in my opinion, real pensions. A real pension is a well-governed, large, defined benefit plan. That's the only way you're going to be able to deal with the various, longevity risk, investment risk, pool resources together, and you will be able to deal with these issues much better with large, well-governed. I keep emphasizing well-governed, defined benefit plans. Now,
well, I can tell you that the word defined benefits is gone from the U.S. vocabulary unless you're working a government employee. And but the corporations, they're gone.
So let's stop right there. Why is it fair that a government employee gets a safe, secure, defined benefit plan, and people working in the private sector are left, to their own devices? Whatever you can save, if you're lucky, you make enough money in the markets, that's fine. But if you're unlucky, tough luck. Now,
Leo, it's now at the stage where I talk to young people and I ask them what they're going to do in their future, and they don't give me a specific occupation. They say work for the government because they see that as offering stability, and maybe they're not worried about pension, but real opportunity. Because if you have a pension with the government, you work 20, 25 years and you're retired, full benefits, probably 70% north of your original of your income. People in the private sector, those pensions are completely gone. They're 65 years old, 70, and they still have to keep working, even if they had put money aside, because they can't make money on the money.
Right.
So the disparity of inequality now is taking on another dimension.
Absolutely.
And with 75 million baby boomers wanting to retire, 10,000 a day, it's becoming blatantly obvious to everybody. And that leads to major social unrest because I don't think that the politicians have even begun to address the problem.
This was the problem they had in Greece. So I'm Greek descent. I go to Greece every year. I visit my family. And throughout the years, the last 30 years, I would hear everybody saying, oh, my kids are going into the public sector. Right, that's great. Until the public sector goes bust. And what happens then, you have to slash pensions, public pensions. And that's exactly what happened in Greece. At one point, the amount of debt just crushed the country, and it's still crushing the country. It's back in recession. They're not implementing the changes that they need to do. Why? Because over the last 30 years, each government in Greece bought votes by expanding the public sector. Well, you and I know that a thriving economy doesn't thrive because of a thriving public sector. It thrives because of a thriving private sector. You need the private sector to pay for your public sector services. And I'm not against the public sector, but the primacy of the private sector is absolutely crucial in any economy. If you do not have a thriving private sector, you can never have a thriving, well-functioning public sector. So all these unfunded liabilities are fine until you reach that last grain of sand of debt, which just crushes you, and then then you're faced with hard choices, which I think Illinois and some states are already faced with right now, saying we can't pay for these promises. Yeah, but you promised us these things. We're public, and I feel for a lot of the school teachers, police officers, firefighters. They're absolutely right. These things were promised to them. These pensions were promised to them. But what happens when, through years of neglect, bad governance, you didn't have risk sharing in their plans, just all these things just accumulated, and then finally you reach a point of no return where you have to make hard political choices.
Because it usually takes a crisis.
It takes a crisis, exactly. I mean, and then the U.S. is lucky in the sense that it can print its way out of any debt, I guess. It's not Greece, and that's fine. But still, you have to make difficult choices when debt levels reach a certain level and people aren't willing to pay more taxes. Quite simply as that. So let's get back on topic because we have a lot to cover. But I'm going to tell you the way I look at the world right now is I always look at bond yields. Why? The lower they go, the higher the future liabilities of every pension fund goes, whether it's defined contribution or defined benefit. The lower bond yields mean that future liabilities are rising. And that mismatch between and you have also assets that are declining. So it's the perfect storm for pensions. Assets are declining, bond yields are declining, liabilities are going up, and you don't have enough to cover future liabilities. And this is where we're at right now. Pretty much every major pension fund is faced with this stark reality that I've just described, and they're asking themselves tough questions. What if bond yields stay low for a decade? I mean, the 10-year U.S. bond yields telling you basically there will be no inflation for the next 10 years, and possibly there will be deflation. What does that mean for pension funds? What does that mean? It means a lot lower returns for the next 10 years. Well, lower returns also means you're going to have to increase, and if you're a risk-sharing plan, you're going to have to increase contributions to make up for the mismatch between assets and liabilities. Do you understand what I'm saying? Mm-hmm. Either you're going to cut benefits or you're going to increase contributions, but one way or another, you've got to make up for that mismatch. And if we're adults, we're going to be talking about these issues openly and honestly, instead of saying, well, we hope. I mean, over the last 20 years, markets average 8%. Forget the last 20 years. The next 20 years will be nothing like the last 20 years. Absolutely nothing like the last 20 years. How do I know? Look at where bond yields are now. Look at the structure of our economy. Look at the structure of markets. It's just vastly different, much more competitive, much harder to make the returns that you used to make because bond yields are low or going to negative. How are you going to make the returns that you made in the last 20 years? It's just not going to happen, Gordon. And I wish politicians were honest to their constituencies and said, we can't afford a lot of these promises that we're making.
We have $7 trillion in bonds, mostly sovereign bonds, now trading with negative rates. Right. $7 trillion, reported by the Financial Times. What does this mean to pensions right now?
So what it means, Gordon, is every global pension fund around the world is looking all over the world and saying, well, where are we going to invest our money? We're not going to buy German bonds. We're going to go and buy treasuries. Even if it's 1.5%, it's better than negative yields, right?
Exactly.
So what does that do? It drives U.S. bond yields a lot lower. And then people are like, wow, the Fed has to raise rates. Well, the Fed can't raise rates because if the Fed raises rates at this point in time, it will absolutely crush the economy. And it will crush a lot of leveraged players, i.e. hedge funds, private equity funds, or whatever, and even banks. So we're in for a very difficult time. And this is why I talk about the new negative normal. When rates are negative all around the world, people jump on U.S. bonds because U.S. bonds are still positive. Well, what happens when U.S. bonds go negative? That's going to be interesting. And then you're going to have a real, you'll see real volatility in the stock market and bond market when that happens.
But there's a big chunk of capital gains on the way from 1.75% down to going negative. That's there. And maybe another point is with that yield, as bad as it is, still being better than zero around the world, the money, as you said, is coming to buy those bonds. You're also making it on currency because it's just forcing the U.S. dollar up.
Right. So one of the
another way of protecting yourself right now. So you're saying it's the good old bond, at least in the short term. You good old
absolutely. When the world a classic flight to safety is everybody buys U.S. Treasury bonds. When everything is going down, your U.S. bonds, even at low yields, will be your ultimate diversifier to preserve your capital. And this is what's happening right now, and you're seeing it. The other thing that I want to say is ultra low rates for a long time means stock markets and corporate bond markets and everything in the public markets, basically, it's going to be a lot more volatile than in the past. If you go back in history and look at regimes of low rates, the volatility in the stock market was huge. So you might have wild swings in the stock market in any given year, even if throughout the year the returns will be either marginally negative or marginally positive. This is what I foresee happening. Well, that's going to force people to start trading more, and once you get into that game, it becomes a very difficult game, right, to start timing markets. And I just think it's going to be a much, much more difficult, and I call it a brutal environment, to be frank with you, for making money. And you see this among the best hedge funds, Gordon. Even the best hedge funds are losing 10, 20, 30%. And these are, top traders, top investors, and they're finding it hard to make money in these markets. And then we expect Joe and Jane Smith to make money in their 401ks over the long run. Like it's just not going to happen. I think we need to start talking about retirement policy, pensions, and taking a hard look at what's working and what's not working. I believe what we have in Canada is working, and I'm going to talk about solutions with you, hopefully. And part of the solution I see is what's going on right now with the government spending on infrastructure and Canadian pension funds needing to invest in infrastructure, because infrastructure is a great investment in terms of giving you safe, predictable yields over a long period. Plus, we all need to invest in infrastructure, including the United States, which has crumbling infrastructure, because that helps your economy grow. Infrastructure jobs are good. They give you a good multiplier. And over the long run, when you improve the infrastructure of your country, you improve the economic prosperity of your country. So I think part of the solution will be in infrastructure spending, whether it's in Canada or the United States. It has to be. You have crumbling infrastructure all over the world. You need to fix it. Pension funds need yield. So pension funds have the capital to help governments invest in infrastructure. Do you understand what I'm saying? Yes. Even though governments are cash strapped, pension funds are looking for yield. They have the money. They can be part of the solution.
I think there's a universal consensus that that's the right move, and to expect that, and more policies will unfold to incent that to happen in regard to infrastructure. Because infrastructure, in fact, is a productivity hit for the country. Good infrastructure makes everything more productive. And until you lose it, you don't really appreciate how important and how vital it is to every country. And I know, look at Asia with the Asian Industrial Investment Bank, $54 trillion. What's it going to be aimed at? Infrastructure. It's called the infrastructure. But that's not replacing. That's building out to give them a competitive advantage. So what are the solutions besides infrastructure?
Well, the other solution I talk about is having realistic investment assumptions, i.e. actuarial target rates of returns. In the U.S., It took them forever to let go of that 8% bogey. Now they're down to 7%, and I think they should lower it down to 6%. And that means when you are targeting a 6% nominal rate, annualized rate of return over 10 years, that in effect tells you that that's our starting point. So we're going to need to raise contributions. And you have to introduce risk sharing in these plans because markets are not always going to go up, Gordon. When markets go down, risk sharing basically means that the stakeholders of the plan are there to share the risk. It's not just the government that's going to take the fall and taxpayers bailing out these pension funds and pension plans. It has to be also the beneficiaries of these pension plans have to assume some form of risk sharing, i.e., in Canada, when markets turn south or when you have a deficit in a pension plan, take the Ontario Teachers Pension Plan or the Healthcare of Ontario Pension Plan, which are two of the best in the world. When they had deficits, they went to their beneficiaries and said, we're going to eliminate inflation, cost of living adjustments, right? They had some discussions, and they said, we got to do this so that we return back to fully funded status of our pension plans. So what I'm trying to say by risk sharing is you cannot expect markets to always bail you out so that you're always fully funded. When markets turn south and your pension plans turn, into a deficit, you need to have some cuts to the benefits. Now we can discuss how you cut the benefit. In Canada, it's been the cost of living adjustment that was cut. But this is how you keep your plans fully funded. And we found here that if you look at any plan in Canada, major public pension plan that's implemented this risk-sharing model, they're pretty much fully funded. There is no problem with our plans that have implemented this risk-sharing model. Why is this not being implemented in the U.S.? I don't understand. I mean, it's just basic logic for me.
I think we call it the ostrich syndrome. We just stick our head in the sand and pretend that it doesn't exist and it goes away, and it's politically something nobody even begins to want to tackle if they did truly understand it.
Right, and that hot potato approach works until it doesn't, until a crisis emerges, and then you have to make drastic political choices. We started in this interview, we were talking about the primaries and the caucuses that are going on in America. I don't think I've heard one discussion on any subject, any debate on pensions. Whether they're funded, unfunded, whether they're sufficient, etc. No,
it's not even in the discussion.
It's not a sexy topic.
But it's the kind of topic that will bring a country to its knees in a massive way. Maybe not suddenly, but over a period of time. There's so much to discuss, and we're really way past our hard line here. And I've got to have you back to keep talking about these subjects because there's so much more to learn. But are there any key messages you'd like to leave today with our listeners?
Well, I think we covered the key messages. The key message, Gordon, is bond yields are going lower to negative. You got to prepare for lower returns for a very long time. That's not just individuals, that's also pension plans. And the liabilities are going up. Future unfunded liabilities are going up as bond yields go lower. And that's going to create a huge amount of stress on public pensions, but also, quite frankly, on Joe and Jane Smith trying to retire out there in a very difficult environment. And I worry about this. I worry about this. I call it a social crisis that's in the making, because as more and more people retire with little to no savings, they're basically relying on Social Security, and that's going to create a whole host of other problems down in the future. And I think nobody's talking about this. This is something on a lot of people's minds, but nobody has come with a clear solution to this. And unfortunately, I will mention one thing. In the United States of America, where we see the opposition to universal health care, there's going to be huge opposition to universal pensions. But something has to be done. Something has to be done. You can put it off for maybe another decade, maybe another 2 decades. But at one point, I think this is going to be a major social crisis. And in fact, it's already happening. I mean, we talked about this at the beginning. Why are people like Bernie Sanders and Donald Trump resonating? There's because they are channeling in the frustrations that people have with the political establishment not answering to their needs, including their retirement needs.
With that, we need to wrap. Leo, I would like to make a comment about the shock that people are having with U.S. Social Security. I was in a conversation, somebody just was retiring, and they said to me, I can't believe the taxation on my Social Security. And I smiled at him because I knew where he was going. He says, do you realize that if I make over $35,000 a year in total tax money that are pensions that I'm taking out, I then have a 50% tax on my pension amount, and over $44,000, I have an 85%. He says, I have to work because I can't live on my pension. Every dollar I pay is over those levels. These are 85% is coming out of my pension contribution. It's taxable at that level. He says, you need $40,000 or $50,000 a year to live. He says, basically, they're taking my Social Security check away. And when you get inside it, people will start to learn the kinds of changes that have been made in the laws and are being changed for various reasons because they're unfunded. I don't know if you're aware of that.
No, I'm not. But then that goes again to taxation policy, and we can talk about that and rising inequality, and whether we should ask people that are making a lot of money to the billionaire class to pay more in their fair share of taxes. And I'm sure Mr. Buffett has his views on that, and as do others.
Clearly that this tax regime change was made really as a tax for qualifications, that if you don't need it, you're going to pay it. You're really effectively going to give it back. The problem is with the basic standard of living today, it's right at the level of people trying to get by, almost the poverty line, that they have to work to offset this. Anyway, we have to break. We're going to come back and talk about more of some of these subjects. I really appreciate the time. This is not a boring subject, obviously.
Well, I could talk about it all day, as you can tell, and I appreciate you giving me the chance to speak on these issues. Hope we can keep the conversation going, and if people want to keep up to date, I would highly recommend they Google up my blog, Pension Pulse, and read my daily comments. And I try to keep things very lively on that blog, as you well know.
I do. Thank you, Leo. Thank you very much.
Talk
to you again. Have a
okay.
Bye-bye.
Bye-bye.